All right, guys, welcome to today's awesome meeting. Welcome to today's awesome class, right? So, today we'll be talking about something very, very important in the forex market, right? So, we've been talking about the candlesticks, right? So, today we'll still talk about a very important pattern in the forex market. Only what I bring to you is something that works. I don't care every other strategies out there that they are sharing and the rest. Is only something that is working, that is I'm gonna share here. Something I use, one of my secrets. That's what I'm gonna share here, definitely. That's what I'm gonna share here, definitely. So today we'll be talking about a very important pattern in the forex market. But before we go ahead, if today is your first time joining this channel, do well to hit the subscribe button, share to your friends. That's the most important one. So that people will come learning about the good news on how to navigate the forex market, no matter wherever you are in the world, no matter wherever you are in the world. Just share to them. The difference we have in just in geographical locations and the rest, but it's still the same thing. The same rule that applies here applies everywhere whenever we talk about the candlesticks. So today we'll be treating a pattern known as the Harami pattern. Known as the Harami pattern. The Harami pattern. That's the pattern we're going to be talking about today, the Harami pattern. Now, some of us, we've been learning the Harami pattern. We've known how to trade it. Some of us, we don't know how to use it. But whether you've been using it, you are not using it, the truth is that you're going to learn it perfectly today. So all you got to do is just to follow to the end. Ask your questions below this video if you have any question and you see yourself trashing it, right? So what is this Harami pattern? This is a Japanese word which means pregnant, which shows reversal in the forex market. So the most important thing I want you to note now is that it shows reversal in the market. I specifically don't want to use every other word, but using that word reversal, right? So the Harami pattern shows reversal. That's a change in direction in the market. That is, if the market is buying, it will get to a particular point. By the time the market is about to reverse or change for itself, is going to give you a reversal pattern, and one of those patterns could be a Harami pattern. That's how it is too for a selling market. That market has been selling. Before it reverses to a buy, it's going to give you a pattern, and one of those patterns is Harami pattern. But guess what? That is the pattern you know, right? That's also the pattern most persons know. But I'm going to show you a different way you can use the Harami pattern and it works for you today. Right, so let's go ahead. There are two types of this Harami pattern. We have the bullish Harami and we also have the bearish Harami pattern. I come again. We have the bullish Harami and we have the bearish Harami pattern. Now, before sharing our screen, checking that on the chart how it looks like, but this how for a bullish Harami, this is how it looks like. For the first time, this is how it looks like. First of all, for the reversal, before I show you the other ways to trade it, the market must be in a downtrend, like trending down, then at the end or at the exhaustion, it gives you a long bearish candlestick, then it gaps up to the inside, giving you something like this, closing inside the previous candlestick or initial candlestick. The next thing you got to do is to go in for a buy. Let me make it more practical for we to understand, right? So these are the characteristics for we to understand this type of candlestick pattern very well. We said this is a reversal pattern, best traded when spotted in the sensitive zone. Best traded when spotted in the sensitive zone, right? Reliable at the higher time frame. What it's just trying to tell you is that when you spot this Harami in your D1, it cannot be compared to someone who spotted the Harami in the H1, and it cannot be compared to someone who spotted the Harami in 30 minutes, cannot be compared to someone who spotted the Harami in 15 minutes time frame, 1 minute time frame, right? So the higher the time frame, the more reliable it is, right? So it can only be traded in an uptrend. It can only be traded in an uptrend. After a deep retracement, to the downside. Now, this is another way you can also trade Harami, which they don't teach us. They only teach us that whenever a Harami is spotted, it's only used in an exhaustion of a downtrend, right? So when that market is selling, when it's exhausted and trying to go up, that's when you use Harami. That's what they teach. But that is not the only thing you use Harami for. You can only use Harami, you can also use Harami when the market is in an uptrend, but after making a deep retracement, a very deep retracement, back to your buying zone or back to the zone you wish to buy the market, you give you a Harami pattern and you go for a buy. Then some persons will be like, tell us more about this Harami. Let's go. I'm going to share more about this Harami after these characteristics, right? So the first candlestick is a long bearish candlestick. Now, the first candlestick, whether in an uptrend or in exhaustion of a downtrend, is a long bearish candlestick. So whether you represent your bearish candlestick, that's your seller's candlestick in red, or any color you represent it, must be long. In a downtrend, in the exhaustion of a downtrend, or in a retracement, it must be long, long. Then the second candlestick opens with a gap to the upside. What do I mean? This is how the Harami pattern looks like. This is in favor of the trend, the market moving this way. You can see it moving down. Now this candlestick is in favor of the trend, in favor of the trend. A long bearish candlestick in favor of the trend. Then the second candlestick opens with a gap to the upside. For you to call it a Harami pattern, there must be a gap. Just the way you find it here. Okay, let me make it this way. Just the way after this long bearish candlestick, there was a gap to the upside. The market did not just start selling from here anymore. There was a gap to the upside. So you must have a gap. The market must not open exactly at the close of the previous candlestick. The market must have a gap, and I've taught what causes gap, which is part of this video in this channel. What causes gap? Gap could be caused as a result of news during the weekend. Gap could be caused as a result of uncertainties in the market, and traders making trades during the weekend rather. Retail traders, for some brokers, are not allowed to trade in the weekend, during the weekend, right? So market makers, the big boys in the market, they trade during the weekend. So that's why on Mondays you see gap in the market, right? So that could be the cause of a gap. The second cause of a gap could be news, breaking news that was never expected could be a cause of gap in the market. So gap, there must be a gap to the upside for you to call it a Harami. That gap simply shows that there is indecision. The sellers that were selling initially, they lost the direction. Sellers have started picking up their profit, especially the market makers. They've started picking up their profits. You see it going, going, going. So that means they've started picking up their profit. That was why there was a sudden shift, a gap to the upside, right? So not only the gap, there must be a gap to the upside, forming the other bullish candlestick in the bullish Harami. The longer the shorter candlestick shows us how imminent the reversal is. The longer the shorter candlestick, it shows us how imminent the reversal would be. So what are we trying to talk about? Right. So this candlestick, the bullish one that is gapping up, that is showing a change of direction, the longer it is, shows us how imminent or the possibility of the market to do what? To reverse for a buy, right? What am I trying to say? Look at this. You can see that this candlestick here is quite long, but this is the secret. But don't tell anybody, but you can share, right? Okay, let's go this way. This is the secret. Whenever there is a gap to the upside, you shouldn't engulf the previous candlestick. This is Harami. This is not other type of patterns. This is Harami. Whenever there is a gap, it shouldn't engulf the previous candlestick, the previous opposite candlestick. This is a gap. It shouldn't engulf the bearish one. No, that if it engulfs it, it's no longer a Harami. Remember, the Harami, the second candlestick has to be inside the previous candlestick. So that is it for a bullish Harami. We're going to spot it on the chart, but before I spot it on the chart, we have to understand it very well. Then we okay. Then we also have the bullish Harami cross. No matter what it is, guys, after the initial bearish long candlestick, you now spot a doji. But before the doji formed, there was a gap. Provided there is a gap, that's the most important thing. Gap to the upside, but later closing at the middle. Closing at the middle, that is known as what? Bullish Harami cross. It still means the same thing. They all mean you should go and buy the market. They all mean you should go and buy. So they all mean we should go and do what? Buy the market, whether it's a doji or it's not a doji, but it should be able to close above with a gap. This is what a Harami is. It shouldn't engulf the previous one. It shouldn't engulf the previous one. It shouldn't engulf the previous one. That is what a Harami is, and that is one of my secrets in this forex market. That is one of my secrets in this forex market. Then we move to the next one before we spot it on the chart, which is the bearish Harami pattern. The bearish Harami pattern. This is a reversal pattern mostly found at the resistance zone. I have my reasons of using the resistance zone because that's the way most of us have been using it. But I also show you another pattern just like the bullish Harami before spotting it on the chart. So this is it. The first candlestick must be a bullish candlestick. The first candlestick must be a bullish candlestick to the upside. Then you now have a smaller candlestick giving a gap to the inside of the previous candlestick. So something like this, you can see buy, buy, buy. It bought to this particular place. What happened? There was a gap. You can see the market did not actually open here at the stop. It gave a gap to the inside like this, closing like this. Look at just take a look at it, a look at this. You can see it's inside the previous candlestick. Man, this is a reversal pattern. It shows a reversal in the market. It shows a reversal, but it can also show continuation. But don't tell anybody. I will show you how it happens. But this shows a reversal in the market. Whenever it's spotted, it's going for a sell. I'm going to share with us how it happens. So this is a reversal pattern. That's the number one thing we have to know. Best traded when spotted in the sensitive resistance zone that is above. Reliable at the higher time frame. It's reliable at the higher time frame. That is when you spot it in D1, it's much more reliable when you spotted in H1, and when you spotted in H1, it's more reliable when spotted in 30 minutes, 15 minutes, and M1. Depending on the type of trader you are, in quote, depending on the type of trader you are, can only be traded in a downtrend after a deep retracement to the upside. So this is where we find a clause. It's not only for a reversal, but it can be used after a retracement, especially after a deep retracement in the market, especially after a deep retracement. That is that market that has been selling. By the time you start making a correction or a deep retracement in the market, after a deep retracement in the market, it gives you a good candlestick confirmation, a good Harami, a good bearish Harami with a long bullish candlestick and the other one inside, as shown to us what causes gap in the market. So the first candlestick is a long bullish candlestick. The first candlestick is a long bullish candlestick, just as seen here. Just as seen here, the first candlestick is a long bullish candlestick. Then the second candlestick in that pattern is a short bearish candlestick, but inside the bullish candlestick, right? So the second candlestick opens with a gap to the downside, but we remain inside the initial candlestick. That's the clause there. Must remain inside the initial bullish candlestick. It must open with a gap down, but must remain inside the initial bullish candlestick. So it must remain here. It must remain inside the initial bullish candlestick. And you can see you see the miracle and the testimonies you're gonna have. The longer the shorter candlestick shows us, the longer the shorter candlestick, it shows us how imminent the reversal is. Now, the longer this shorter candlestick will be, it's going to tell us how imminent or how far this trend reversal is going to happen. Whether it's going to take a short time or it's going to take a long time. That's the shorter the longer this shorter candlestick is, but must not engulf the previous bullish candlestick. I come again, must not engulf the previous bullish candlestick, right? So this is how it looks like here. You can see it, buying. Ordinarily, market is supposed to continue from here, whether bearish, even though it wants to give us a reversal pattern, giving us a bearish engulfing. But no, it gave a gap, then in the middle, closing in the middle, closing in the middle, closing in the middle here, and you can see what happens. Sell. So this is what bearish Harami looks like. So before we continue, let's quickly get to the chart, see how it is in the chart. Let's quickly get to the chart, see how it is in the chart. Then we'll know, before we'll know what to do, right? So this is the chart. This is the chart. Let's quickly get to the, this is the chart. Moving to the chart. So let's see if we will spot, though it's not that common. It's not that common. It's not that common. But one thing is sure, whenever it's spotted, it plays out. One thing is sure, whenever it's spotted, it plays out. Now look at this. This is a Harami pattern. This is a Harami pattern, but it's not a perfect, a bearish Harami pattern, but it's not a perfect bearish Harami pattern. Though it's still a Harami pattern. At the end of the day, what you see here, the market went down. Why I don't want to use this is for we to see it very well. Not that when you see this, it's not a Harami, it's still a Harami pattern. When you spot this, this is a Harami pattern, a Harami pattern. Don't say the gap is not too much. This gap, especially for you to give a gap from here to this particular place, is a Harami pattern. Let me zoom in. Let me zoom in. This is it. This is a Harami pattern. You can see there was a gap to the downside but could not engulf this. At the end of the day, the market fell. It's a Harami pattern. So these things work. This is also a Harami pattern. This is a bullish Harami. Initially, the market selling, but when it got to this place, what happened? It gave a gap to the upside. At the end of the day, there was a buy. It's still a Harami pattern. Oh my God. This is a bearish Harami. Buying, but there was a gap to the downside. Try buying, but no way. It closed in the middle. What happened? The market sold. The market sold. It's still a Harami pattern in the forex market. So let's go to Aussie USD. I think there was a time it was too obvious. Aussie USD, Aussie USD, Aussie USD. So Aussie USD, let's go for Aussie USD. I think we have it here. Okay, this is it. Aussie USD. So let's see if we can find any Harami pattern. Let's go. Let's go. Aussie USD. Oh, this is still a Harami pattern. This is a bullish Harami. Let me zoom it in for we to see it. So it wouldn't look like, oh, I'm not, this is it. You can see sell to this place, but at the end of the day, there was a gap to the upside and market closed in. And at the end of the day, what happened? Market bought and bought and bought. Set your stop loss behind. This is a shift. A shift. Remember, you can also use it in favor of the trend, but allow a deep retracement, right? Are you enjoying this video? Do well to share to your friends. Invite them so they will benefit from everything that is accruable from this class, right? Invite them, and if it's your first time, subscribe to the channel, right? So as a way of recap, we started with the Harami pattern. As a way of recap, we started with the Harami pattern, and we said the Harami pattern. This is a Japanese word which means pregnant. Pregnant, and we have two types. We have the bullish harami and the bearish harami. The most important thing you got to know is that it's a reversal pattern, and this is how the bullish harami looks like after a very bearish candlestick. There is a gap. That gap must be there. Oh my goodness, that gap must be there. I'm saying what works for me, right? So we went for the characteristic. This is a reversal pattern, best traded when spotted in the sensitive support zone, reliable at the higher time frame, can only be traded in an uptrend after a deep retracement to the downside. Now you can also trade it in an uptrend for a bullish harami, but you must allow for a deep retracement to the downside. And also remember, the higher the time frame, the better for it. The higher the time frame, the better for it, right? So this is also a bullish harami, how it looks like. No matter how the previous candlestick closes, there must be a close to the upside. There must be a gap to the upside for you to call it a harami pattern. All these things must be in place. Now this is how bullish harami cross. It's still the same thing, but the difference is that this smaller candlestick in the middle is a doji, but it will still head to the upside. It will still head to the upside. Some persons call it doji harami. Some persons call it bullish harami. Bullish harami cross, right? Bullish harami cross. Some persons call it doji harami, bullish doji harami. So that's it. Then for the bearish harami, it's a reversal pattern mostly found at the resistance zone, right? So this is how it is. First bullish, then there must be a gap down to close below, right? So this is a wonderful secret. You can see it's a reversal pattern best traded when spotted in the sensitive resistance zone, reliable at the higher time frame, can be traded in a downtrend after a deep retracement to the upside. The first candlestick is a long bullish candlestick. The second candlestick opens with a gap to the downside but will remain inside the initial candlestick. The longer the short candlestick shows us how imminent the reversal is. So this is how it looks like to the upside. Then there must be a gap. Close it inside. It must close inside. So in a nutshell, this is how it looks like. Another word for the harami is known as the pregnant woman, right? So this is it. But what I want us to take home is that it's a reversal pattern in the market, and it can also be used in favor of the trend, right? Which they don't often tell us, but to use it in favor of the trend, there must be a deep retracement for the bullish harami, then giving you a good harami pattern. Don't even look at anybody's face. Enter for a buy, then for the bearish harami in a downtrend, deep retracement, giving you confirmation above, you can go in for a sell. Another way is waiting for it at a sensitive support zone and resistance zone, that's at exhaustion point. Are you enjoying this video? Remember to let your friends know about it. All right, thank you. See you in our next meeting with a whole lot of cash. A whole lot of cash. So in your next meeting with a whole lot of cash.